welcome back to my channel. Welcome back to the Riggy Report. I'm Riggy, and today we're going to tackle the topic of debt consolidation. So right now we're in a recession, and I know a lot of people are trying to get their finances in order, and a lot of people have credit card debt or student loans or just different types of debt that they're trying to work through. And one way that you can do that is doing a debt consolidation. So a debt consolidation is just a way of restructuring the loans or type of credit you currently have to make it easier to handle and simpler. So an example, which is the one that's most common, is let's say you have 3 different credit cards, right? All 3 of your credit cards have different balances. You might have all 3 credit cards with different companies, and they all have different interest rates. So credit card interest rates are notoriously really high. I've seen credit card interest rates go as high up to like 27%. You have to make the payments at different times. So one way that you would consolidate your debt is to go to a lender and you say, okay, so I have 3 credit cards. Instead of paying them at different times, I want to take out a loan, pay off the credit cards, and then pay the loan instead. So that would be a way to consolidate debt, right? That would convert all of your loans into one payment. You only have to worry about one lender, and usually you would be able to get a much lower rate than what you're paying, a much lower APR than what you're already paying with your credit cards. Now, there are a lot of different ways and a lot of different credit options for you to be able to utilize to do a debt consolidation. The very first one would be a credit card balance transfer. So let's say you have a credit card with a very high balance. You can apply for another credit card that gives you like no APR for about a year or a year and a half. That way, you're able to pay that credit card off before the interest starts accruing. Number 2, you can do a debt consolidation loan. This one is the most common. People just go to their home banks and sit down with the banker and say, hey, this is the problem I'm having. The banker takes your information, they put it in the system, and then they're able to give you an estimate of, let's say you ask for $25,000, they might not be able to give you $25,000, they could give you 10 or 15. You work with them, you close on the loan, you pay your existing debt, and now you just have the debt with one bank. Another example credit option you can use for debt consolidation is a home equity line of credit. Banks are not really doing home equity lines of credit right now, but it is a good option. So with the home equity line of credit, you just take the equity from your house and you put it as collateral for the line of credit. So the benefit of that is you get a lower rate than what you would get if you just did a regular debt consolidation loan, because with the regular debt consolidation loan, it's not backed by anything, so there's no collateral. So using your home as collateral gives you a lower interest. Now with the home equity line of credit, this one is one that is really you really wouldn't want to do it unless you're in a really tough situation, because you do have to put up your home as collateral. So using a home equity line of credit is, you're basically saying that, okay, I'm going to borrow this money, but in the event that I don't pay back, then you can either foreclose on my home, or you can put a lien against my home, which is really, really like scary, because your home is where you live, it's where you have your kids, it's where you have your stuff, your wife, your dog, your husband. So you really want to be careful with these home equity line of credit loans, okay? And the last thing is a cash out refinance. So cash out refinances right now is something that the banks were doing a lot earlier this year. So when you do a cash out refinance, you just take out the equity you already have in the house, and then you refinance the loan. So let's say, for example, your mortgage, you already had a mortgage that you were paying on for years, and the balance of the mortgage was, let's say, $100,000. But the home is worth $300,000. So you say, okay, I'm going to take out $20,000 of equity. So now you go to the bank, they're like, okay, they take the money that you already owed, the mortgage you already had for $100,000, they add another $20,000 on top of that, and then they give you that $20,000 in your hand. So you just borrowing the equity. Okay, so now that we know what debt consolidation is, what are the costs associated with this consolidation? Well, that is greatly going to differ depending on what type of credit vehicle you choose to use. So for example, if you're doing a balance transfer, most credit cards have a balance transfer fee of between 3 and 5%. So 3 and 5% of your balance that you're transferring is what they're going to charge you. Versus if you're doing like a personal loan, you're going to have to pay the interest of the personal loan, as well as, let's say, if they have origination fees, or in the state of Florida, dot stamp fees. If you choose to do a home equity line of credit, then you're going to have to pay different fees for that as well. So what you choose to do, you have to really sit down and think about it carefully, because every different ones that you choose have different benefits, and they also have different costs. Looking into debt consolidation is really, really good as a way to try to just get control of your finances. However, it does have pros and it does have cons. So we're going to go over both. So the biggest pro of doing a debt consolidation would be making it easier to manage your expenses as well as manage your debt by putting multiple loans into one loan, so that you'll have a fixed payment every month and you have just one lender to worry about. So the second one would be you get a possible lower interest rate. So for example, if you had 3 credit cards and you're paying about 27% each, you could probably get a loan where you're paying about 11 to 12%. And also it could lower your monthly payment, because you're having to make one payment over a longer period of time versus having a credit account that's revolving monthly, and it's just a revolving credit account and they're charging you more for it, right? So the cons of a debt consolidation would be, number one, you might not actually get approved, because one of the things that lenders do look at when they're doing your application, and underwriters look at when they're qualifying you, is your debt to income ratio. So if your debt is already a little too high, or if it's past a certain threshold, they're not going to approve you. Number two is, depending on how much debt you actually have, the length of the loan might be a little too long. So if you're not proactive in paying off and making extra payments, in the long run you might end up paying a lot of interest. And number three, if you choose to do something like a HELOC, then you would have to put up your home as collateral. And if anything were to happen, you could possibly risk your home going into foreclosure or having a lien placed on your home. So that's all we have for today. If you guys have any comments or questions, please leave them back down below, and I will be more than happy to answer anything you would have, if that's all there is today. So don't forget to like, comment, and subscribe, and have a great one.